Welcome to JPNDC and the workshop Credit 101, the road to a perfect credit score. My name is Paola Liendo, and today we will be talking a little more about credit. But first, let's talk about who we are. What's JPNDC? JPNDC is a community-based organization in Boston, and our mission is to transform the lives and amplify the voices of Boston residents who have been excluded from prosperity by an inequitable economic system. And one of our programs is the Family Prosperity Services, which I'm going to talk more about today. We offer financial skills training like this one that you are listening today. We also offer one-on-one financial coaching. Here is where the magic happens, because here's where we work with you one-on-one, and we focus on what your goals are and how to support you to reach those goals. We also offer employment and career services. This includes training and also one-on-one coaching. Stabilization services, so you can maximize your income, and referrals to ESOL classes, English classes, and other job training opportunities. So today we want to talk about what is credit. Credit is the ability to borrow money or access goods or services with the understanding that you will pay later. Basically, there's three types of credit. One are revolving accounts. We know them better as credit cards. Installment loans that are any other type of loan, and open credit. Why do we need credit? Credit can be useful when we have an emergency. Instead of having to borrow money from a friend or a family member, we just can access to the line of credit or the credit cards that we have. It becomes quick to access resources in case of that we need them, and can be many times more convenient than carrying cash, and safer as well. Large purchases can be paid over time. For example, if we want to buy a car in cash, we might have to save for a long time, but if we have a good credit, we can have that car much sooner and then pay it over time. But it can also affect us negatively. It can affect our ability to obtain a job, housing, insurance, and others. There are 5 decisive factors when applying for credit. The first one is capacity. Do I have the capacity to pay back the loan? After I pay my rent, my utilities, all my expenses, do I still have some money left so I can pay back my loan on time? The second one is capital. What do I have accumulated over time that I can show up for? And this comes directly related with the next one, that it's collateral. If I don't pay back my loan, what are you going to take from me? Or how am I going to repay the lender? The fourth one is probably one of the most important ones, and it's character. And this is how I, as a customer, have behaved in the past. What is the character that I have? Am I a good customer, that I am always paying on time and I am not asking for extensions? Or I am a customer that had issues in the past and I have derogatory marks on my credit. And finally, the fifth one is conditions of the market. We don't have much weight on this, but we get affected. One of the most significant ones are the interest rates. Sometimes they're higher, sometimes they're lower, and those are conditions that we have to accept as consumers. So all the information that we have talked, it's summarized in what is called the credit report. A credit report, it's a summary of all your credit history and personal information. There are 3 major companies that are the credit reporting companies, and they are Experian, Equifax, and TransUnion. Those 3 companies are private companies, which their business is to put together these credit reports so lenders have easy access to them, and they can evaluate you as a customer when you're applying for credit. We as consumers, we can access our own credit report for free at annualcreditreport.com. This is a federal website where we can access our credit report for free once a year, which means that you will see 3 credit reports for free in 1 year, one from Experian, one from Equifax, and one from TransUnion. And our advice is that you pull one every 4 months so you can see how your credit is going through the year. Why you should order your credit report, why you should be seeing your credit report. It is very important to check at least once a year, first from the accuracy. We want to know that our name is well spelled, that the addresses that are on the credit report are places where we have lived, and all accounts belong to us. 2 in 5 credit reports contain errors, and these errors are very costly for us as a consumers because those errors end up on being lower credit scores that we're gonna talking a little bit more about that. But if we see that our credit report contains names that are not ours, addresses that are not ours, or we don't recognize accounts, it's important that we take action because these can be signs that someone else is using our information. And unfortunately, those days, it's very common that someone has to steal your information. So we were talking a little earlier about a credit score. If you think about a credit report and a credit score, the credit report is your test and your credit score is the score based on the answers on your test. The credit score is based on the information that is in your credit report. So it could be that someone has a credit report but not a score because there is not enough information. But other than that, it's just a numeric value. It's a score. And it will show you how good or how bad is your credit. The most known and the most used is the FICO score. The FICO credit score goes from 300 to 850. And all of us are somewhere in between those numbers. The higher your credit score, the better options you're going to have, the better interest rates, the better lenders that you're going to have access to. There is 5 key factors that affect how our credit score is calculated. More than 1/3, it comes from the payment history. 35% of our credit score is based on on-time payments. If we have never missed one payment, we are going to have all the points from this category. If we have some late payments, but mostly good payments, then we're going to have most of the points. The second factor is the amount of debt. 30% is going to come directly from your credit cards. And that is why it's so important to have at least one credit card open so you can have a better credit score. As a rule of thumb, we should not go above 30% of the available credit. This means that if we have a credit card with $1,000 of available credit, we shouldn't use more than 300. As soon as we go above that mark, then we start losing some points. Another 15% comes from the credit history. The longer you have a credit history, the better you are. Because the banks, the lenders want to know how do you behave during good times, during bad times, and in any time in between. So if you don't have any credit, it's important to start building a healthy credit history. 10% of the credit score also comes from new applications. New applications are considered every time that you request credit. Either is it a credit card, a store card, or if you're trying to open a new phone line, for example. And every time that we apply for credit, regardless if we get approved or denied, then those are some points that we're going to be losing from our credit score. So it is very important that 1, we only apply for credit that we actually need, but 2, that we don't make too many applications. Just think about it. During Christmas time, every time that we go to a store, we are going to be offered a credit card. And if we apply for 1, we might lose between 5 and 10 points. But if we apply for 10, we might lose between 50 and 100 points. And to recover all those points is going to take at least a year. So it's very important to be smart at the time of applying for a new credit. And the last 10% comes from the credit mix. It is better, it looks better if you have different types of credit, like a student loan, a car loan, a credit card. But most important than having a credit mix is to only have credit that you actually need and you actually can afford. We have been talking a lot about credit history, credit reports, and credit scores. But how can your credit can affect your pocket, the money that you spend every month? If you can see on this table, we are talking about a car loan, someone that is buying a new car. The car, if you have a very low credit score, below 550, you are considered very risky. And your credit, the interest rate is going to be pretty high. So will be your monthly payment, and you may not get approved for a loan altogether. And you will have to purchase wherever it's available at that moment. When you have poor and average credit, you're going to see that the interest rates are starting to go down, and so is your monthly payment. You may get a loan, but it's going to be a much higher rate. Once you have good or excellent credit, you start seeing the best options in the market. So your interest rate is going much lower. Most lenders will approve it, and you will be able to choose not only the car you want, but you're going to have many more options and more perks that they are going to be offering to you because you are considered a trustworthy client. And as you can see, for the same car that someone is buying with bad credit, they are going to be paying $19,000 over a couple of years. During the same period of time, if someone that has excellent credit will be paying $15,000. So there is a difference of almost $4,000 just because of the credit, your credit score. How to build or rebuild the credit score. The first thing that you need to do is order a detailed credit report to know exactly what it is on your credit report. Remember that on-time payments build good credit, and also to make a smart plan to pay your debt. What does a smart plan means? Means it's a specific, you know exactly how much you own, how much interest you are paying, and how much interest you are paying. It's measurable. You know how many months is it going to take. It's attainable. You have a budget. You know exactly how much you can afford to pay without getting late on anything else. It's realistic because it is according to the plan that you have, and it's time-based. You know how long is it going to take you to pay off your debt. And finally, don't deal with collectors unless you are ready to make an offer. Collectors can be very tricky, and they not always have the right to collect on you. So if you are dealing with collectors, we invite you to give us a call or send us an email, and we will help you identify who they are and if you have an obligation to pay them. In order to build credit, keep your balances as low as possible. Only charge things that you really need. Apply, as we have talked before, apply for credit only as needed. Never close a credit card account without a plan. If you pay it off, just leave it open. You don't need to make purchases every month in order for your card to stay open. And if you have any questions, ask for help. Give us a call at JPNDC to the program staff. Our services are completely free of charge, and we will work with you. I am Paola Liendo. I am the Senior Financial Coach, and my team are Enrique Ponce, our Career Coach, and Joan Morales, our Second Financial Coach. If you have any questions, please do not hesitate to contact us. Thank you for watching, and let us know if we can assist you in any way.